Welcome to the deep dive. Ross Stores reported Q1 earnings. Beat expectations.
Yeah, 1.47 EPS, $5 billion revenue. Look good on paper.
But the stock plummeted, over 11%. So, what happened? Let's get into it.
Okay, let's unpack it. Ross Stores' first quarter, it did look pretty decent at first glance. They definitely exceeded expectation.
Right, the EPS, that's earnings per share, was $1.47.
Yeah.
Better than the forecast.
Exactly, beat by about 4 cents. And revenue also came in slightly ahead, around $5 billion. That's up maybe to 2.5%, 3% from last year.
Okay, so growth, albeit modest. What about sales at existing stores, comp sales?
Well, that's where it gets a bit flat. Comparable store sales were flat year over year.
Flat. Not exactly exciting.
No, but they did mention seeing improvement month to month during the quarter. Like February started slow, March got better, and April was actually quite strong.
Okay, so some positive momentum building within the quarter. But we dig a bit deeper. Net income.
Yeah, that actually dipped slightly. It was $479 million, down from $488 million the year before.
So revenue up, profit down slightly. Operating margin.
That held steady, actually, 12.2%, consistent with last year. And they kept buying back shares, about 2 million shares repurchased. They're on track for their planned buyback this year.
Okay, so some financial levers being pulled. But it still feels like those headline beats weren't the whole picture. What else stood out in Q1?
I think the inventory number is worth noting. It's up 8% compared to last year.
8%. That sounds like quite a bit.
It is. Average store inventory is up 4%. They mentioned making opportunistic buys, and their pack-away levels, that stuff they buy cheap in store for later, were around 41%, similar to last year.
So is that good or bad? Getting deals sounds good, but holding inventory.
It's a double-edged sword, right? It could mean they snagged great deals or are anticipating demand, but it also ties up cash and, carries risk if trends shift or the economy slows.
Makes sense. And they're still opening stores?
Yep, opened 16 new Ross locations and 3 BD's discounts in Q1. Plan is for about 90 new stores total this fiscal year, so still focused on expansion.
All right, so a bit of a mixed bag in Q1. But it really feels like the market's huge negative reaction wasn't about Q1 results. It was about the outlook, wasn't it? Particularly around tariffs.
Absolutely. That seems to be the crux of it. The CEO, Jim Conroy, specifically mentioned heightened macroeconomic and geopolitical uncertainty.
Standard cautious language, maybe?
Well, he zeroed in on prolonged inflation and evolving trade policies. That trade policies bit, that's the key. That's what spooked investors, I think.
Because of China, right.
Yeah.
Even if they don't import directly.
Precisely. Ross stated that over half of the goods they sell originate from China. So even if they buy from a U.S. vendor, that vendor is likely importing from China and facing tariffs.
So the costs get passed down the chain, potentially hitting Ross's profitability.
Exactly. And this uncertainty, this risk, led them to do something pretty significant. They withdrew their full-year sales and earnings guidance for fiscal 2025.
Wow. Okay, pulling the whole year's forecast. Yeah, the market hates that kind of unpredictability. That's a major red flag.
It really is. And the guidance they did give, just for Q2, wasn't exactly confidence-inspiring either.
What did they project for Q2?
Comparable store sales, they see flat to up 3%, which, isn't terrible, especially following a 4% gain last year, but...
Okay, there's a but coming, isn't there?
The but is the earnings per share forecast for Q2. They guided $1.40 to $1.55. That's down from $1.59 in Q2 last year, and it was notably below what analysts were expecting, which was closer to $1.66.
Oof. Yeah, that's a miss versus expectations and a year-over-year decline. Did they say why it was lower?
They did. They specifically called out an estimated 11 to 16 cents per share negative impact baked into that Q2 guidance directly from the announced tariffs.
So they quantified the hit already, 11 to 16 cents just from tariffs in one quarter.
Right. That translates to roughly a 90 to 120 basis point hit to their operating margin. That's almost 1 to 1.2 percentage points shaved off their profit margin just from tariffs. And that includes costs for goods that were already on the water when the tariffs were announced.
So no way to avoid those initial costs. Okay, now the stock drop makes a lot more sense. Q1 beat. Fine. But Q2 looks weaker due to tariffs, and the rest of the year is a total question mark.
Exactly. Investors look forward, and the forward look suddenly got very murky, very fast. That withdrawal of full-year guidance combined with the lower Q2 forecast, that's what triggered the sell-off.
Which was reported as what, over 9%, 10%, even 11%? Yeah. Pretty sharp reaction.
Yeah, a significant drop. And you also have to consider some analysis, like from Investing Pro, suggested the stock might have been seen as near fair value already. Maybe some technical indicators pointed to it being a bit overbought.
Ah, so maybe it was primed for a pullback, and this tariff news was the catalyst.
Could be part of the story. When a stock is maybe fully valued, any whiff of bad news or increased uncertainty can lead to a pretty significant correction.
Okay, so given these headwinds, what's Ross actually planning to do about the tariffs?
Yeah.
They must have strategies.
They outlined a few things on their earnings call. First, the obvious one, talking to their vendors, trying to negotiate better costing to offset some of the tariff impact.
Meaning on suppliers. Standard playbook. What else?
Second, they're being really cautious about raising prices for shoppers. They emphasized maintaining that substantial pricing umbrella, basically, keeping prices well below traditional retailers. Value is their whole game.
Right, they can't afford to lose that edge. Makes sense.
Third, they plan to leverage closeouts that are already physically in the U.S., so those wouldn't be subject to new import tariffs.
Smart. Use what's already here.
Fourth, using their packaway inventory. Remember that stuff they bought earlier? If they bought it pre-tariff, that helps too.
Okay. And fifth, any longer-term plans?
Fifth, they mentioned exploring shifting the country of origin for some goods, moving sourcing away from China. But they were clear that's more of a, longer-term effort, not an immediate solution.
Got it. Those all sound like logical steps, but it's a tough situation. What else came out of the earnings call? Maybe from the analyst Q&A. That's often where you get more color.
It is. There was discussion about that Q1 sales improvement. They said it was pretty broad-based across merchandise categories as the quarter progressed.
Okay, not just one hot area driving it.
Right. And naturally, analysts pushed hard on the tariff impact for the second half of the year. But management basically said there are just too many variables right now. Trade policy changes, vendor responses, consumer reaction to give a reliable prediction.
So sticking with the uncertainty theme, what about inventory availability later in the year, if China production gets disrupted?
Yeah, that came up. They expect good closeout availability in the near term, but there is a potential concern about a gap later on if Chinese factories halt or slow production due to the tariffs and general uncertainty.
Potential sourcing crunch down the line. How did Ross respond?
They expressed confidence, saying they believe they're extremely well positioned to manage through that, likely referring to their flexible model and packaway strategy.
Okay, something to watch. What else? Branded merchandise. That was an issue for them before.
They said that strategy is now considered successfully executed. It's no longer a drag on margins, and the ladies' apparel business, which is huge for them, is performing in line with the chain average now. So, positive developments there.
Good news there. What about pricing? If they do have to raise prices because of tariffs, how much flex do they have?
That's the million-dollar question, right? Pricing elasticity. Management said it really depends on the category. They'll be strategic, watching competitors, watching mainstream retail, but they do expect broad-based inflationary pressure across retail if these tariffs stick.
Meaning, if everyone's costs go up, maybe they can pass some of it on without losing their value edge.
That seems to be the thinking. If the whole retail landscape sees prices rise, their relative value proposition might hold, even with some increases.
Interesting. And that idea of shifting sourcing away from China. Any more detail on the timeline?
They reiterated that while they have flexibility, it's item-dependent, timing-dependent. Resourcing takes months, and a significant shift away from China is probably more of a 2026 prospect, not something that solves the immediate tariff issue.
Okay. Do they talk about the customer? Are they seeing more trade-down shoppers coming from department stores?
Apparently not seeing a clear trend there yet. They said comp performance was pretty broad-based across different income levels.
So how did they get to flat comps overall then?
It was driven by a slightly higher average basket, people spending a bit more per trip, offsetting a slight decline in traffic, especially earlier in Q1.
Gotcha. Basket up, traffic down slightly. Anything else notable from the Q&A? Costs. Categories.
Quick hits. SG&A costs, they generally need 3-4% comp growth long-term to leverage those fixed costs. Category-wise, cosmetics was called out as the strongest performer. No specific issues flagged in children's wear.
Okay, and store performance. Any regional differences?
Yes. They noted that stores near the Texas border were negatively impacted by delays in cross-border traffic from Mexico. But on the plus side, their smaller chain, DD's Discounts, continued its strong momentum.
And merchandise margin, looking ahead to Q2.
Excluding the tariff impact we already discussed, they expect merchandise margin to be roughly neutral, so similar to last year.
So, stripping out tariffs, The underlying margin looks stable for now.
Seems that way, yes.
Okay, so wrapping this up. It's really a tale of two stories, isn't it? A decent Q1 performance, completely overshadowed by future tariff fears and the resulting guidance withdrawal.
Absolutely. You have the backward look, Q1 beat earnings, beat revenue. Then you have the forward look, major uncertainty tied to tariffs, quantified negative impact in Q2, and a big question mark for the rest of the year. The market clearly focused on the latter.
And it just hammers home how sensitive retailers, even off-price ones like Ross, are to these big geopolitical trade winds. Even indirect exposure matters a lot.
It really does. Their ability now to, manage those vendor costs, use their inventory smartly, make careful pricing decisions, and just generally navigate this choppy water, that's going to be crucial. They talked about their experienced team and flexible model. Well, they'll certainly need both.
So the key takeaway here is that the near-term path for Ross looks, well, uncertain, largely due to external factors beyond their direct control.
That sums it up well. The focus shifts from Q1's results to how effectively they can mitigate these tariff impacts and maintain that all-important value proposition for you, the shopper.
Which leaves us with a broader thought, doesn't it? Given how deeply intertwined the entire retail sector is with goods originating from China, how might these ongoing trade policy shifts continue to ripple through the economy? What could the longer-term impact be, not just for businesses, but for all of us as consumers?
That's the big question to ponder, definitely. How does this reshape supply chains, pricing, and consumer choice down the road? It's a story that's far from over.